Hi, I'm Sean Ferrugia. Welcome to the 2023 edition of our annual budget wrap-up. This is the first full federal budget that has been announced by Jim Chalmers and the newly elected Labor government. This budget doesn't have a huge amount for us to discuss today on for small to medium-sized business owners and our general client base. But there are a few things to keep in mind and to get an idea of where the government's thoughts are and the policies that they're looking at implementing. The budget last night was really focused on getting the inflation back under control and easing cost of living pressures. So with that, there wasn't a huge amount of spending and not a huge amount of new announcements that would potentially cause more inflationary pressures. So I'm not going to go through the economics of it. That's really not my area, and I'll leave that to someone that's more qualified to discuss it. But just in high level sort of terms, there was a budget surplus this year, and that's due to the economy sort of booming up and prices rising. It's resulted in some increased tax revenue for the government, but that surplus is not expected to last. So it's a bit more of a sugar hit to the government. But inflation has annualized in the March quarter, so that's January to March 2023, to 7%. This is forecast to drop sharply to 3.25% in the next financial year, so that's from July 23 to June 24. And then it's likely to go, or forecast to go back down to the target area of between 2 to 3% in the 24 to 25 financial year. So what this means is that inflation is still going to be above sort of the expected band up until around about July next year and even into that next year there. GDP, so gross domestic product in real terms, so this is everything that the country does produce, is expected to slow to 1.5% next year and then rising back up to 2.25% in the 24-25 financial year. What this means is the government really isn't forecasting a recession of any sort. I guess if they did, it would probably cause some panic. So whether or not it comes or not, we don't know, but the government for these purposes, they're not expecting that it will be there. Like I was mentioning, the primary aim of this budget was to ease cost of living and the inflationary pressures. So what they've done there is they've really put in quite a few measures to do with individual taxpayers, but more focused on lower income earners to assist with the cost of living because it's not really going to create any other spend. So one of the items announced was exempting lump sum E's from Medicare levy. So what this is that if an employer has to back pay you because they've underpaid you throughout a period of time, lump sum E basically allocates that revenue to the year that it should have been taxed. Now, in the current rules, if you get a big lump sum in a current year, you'll get taxed or get charged Medicare levy rather on the full lump sum amount. Now, if you're a low income earner and you haven't actually paid Medicare levy in the last couple of years, maybe you've been transitioning to retirement, then it is seen as unfair. So what this change is doing is basically looking at the last couple of years. If you had a reduction or an exemption from Medicare, then that will follow in on the lump sum E, even though your income in the current year may be a little bit higher. The other sort of changes around sort of the low income space is the Medicare levy low income threshold. So this is the threshold before you start paying Medicare levy, is increasing slightly to $24,000 for a single or $40,000 for families. And this is up by about $1,000 each way in line with inflation. The government also announced a package of up to $500 in electricity bill relief for 5 million households. These households are pretty much either senior healthcare card holders, so that's old age, maybe not in the pension area, but they do have that low income where they can get the healthcare card, or they're receiving a payment from Services Australia, so family tax benefit, job seeker, all those kind of things, or anything up to the age pension. On the topic of job seeker, this is being increased by $40 a fortnight from September to assist with cost of living. The single parenting cutoff is being raised for single parenting payment is being raised from 8 to 14. This is a good measure. It's always been one that's baffled me as to why it cut off at 8. But what this really means is rather than when the youngest kid turns 8, the mother having to go on to job seeker, which is the old dole, or potentially finding work, to have the payment, I guess, carry on up until that phase. That gives some other concessions as well, such as pension offsets and a few bits and pieces there. So I guess that's welcome for people who are getting those payments. Rent assistance is increasing by 15%, so that's aimed to assist slightly with the cost of living. But one of the really big things that has been announced that we find will be pretty helpful is increasing incentives to GPs to bulk bill concession card holders and kids under 16. So with a lot of these rates for GPs and bulk billing being frozen, a lot of clinics have had to survive, go to mixed billing and private billing models. By increasing these incentives for kids under 16 and people on concession cards, this is going to make a GP visit more affordable, going forward, which is definitely going to be welcome. So next thing we're going to go through is the main key of what you're probably interested in as our client base and why you're listening to me today is the changes for small businesses. So there's not a massive amount here that is great, but there are some things that you really do need to be aware of, and especially leading up to June 30 and making sure that you're managing your affairs in the best way possible. So the instant asset write-off, which is currently at $150,000, is being reduced back down to $20,000 from 1st of July 2023. So pretty much in a couple of weeks, about 6 weeks time. So what this really means is that it's back to the old sort of system there, that if you're buying an asset for your business, whether it be a car, an excavator, or some sort of furnishings or equipment, each asset is assessed on its own merits. If it's under $20,000, you'll get a tax deduction on it in the first year. If it's over, it gets added onto what's called the general pool. The general pool is taxed at 15%, deducted at 15% in the first year, and then in 30% in the following years to tease out the tax deduction. So you're not really losing or gaining anything out of this. It's really just a timing difference, but it does impact short-term cash flow. So it would have been nice to have a higher limit. But for illustrative purposes, what you're really looking at with this is that if you buy a car now, let's say you buy a car, it's right up to the luxury car limit, which you can deduct, which is $60,000. And let's assume this car is 100% for business purposes. If this car gets delivered to you on the 30th of June this year, you can deduct that entire $60,000 off your income this year in itself. Now, what that means is that basically becomes a tax break in real cash savings of up to between $15,000 if you're a company and you've got a tax rate of 25%, or up to $28,000 if you're on the highest marginal tax rate. So that's a nice big immediate tax saving that you're getting by having that car that's 100% for business use delivered before 30 June. Now, if this same car that you've ordered now gets delivered on the 1st of July, what happens is that that car has to be added onto the general pool because it's over the 20 grand. What this then means is only 15% is deductible in the next financial year. And what this basically does is creates the cash benefit of only between $2,250 up to about $4,200. So that's a big difference between 15 to 28K. So if you have ordered any assets, or is there anything you do need for your business, it is worth considering getting it and making sure it's ready and installed for use prior to 30 June if you are wanting those tax savings. There are some circumstances where it might be better to farm it out to the next year, but let's discuss that in tax planning when we do catch up. The other big measure that was announced is the energy incentive. So this is for businesses turning under $50 million. They will get a bonus incentive for spending on some energy efficiency for their business of up to 20%. So there's a cap of $100,000 on this. The details are still very vague and sketchy, but basically if you're spending under or up to $100,000 and you are an eligible business, you'll get a 20% bonus deduction. So what that means is you'll get to deduct $120,000 off your income rather than the $20,000. The general pool rules and everything will apply, so that deduction will be teased out over time. I dare say the $20,000 bonus will be deductible up front, but the legislation isn't clear on this at the moment. So what this is designed to help is, to install and to change in your business heating and cooling systems, efficient, put efficient fridges and cooktops if you're a business that has kitchen facilities, as well as getting things like batteries and pumps and all that installed. Their full list will be announced in due course. It's not out yet, but it will last, and anything that you do buy has to be installed by 30 June 2024 to get the deduction. What they have said already is that there's no capital works items that are going to be allowed. So this is anything that's overly structural in nature, and whatever it is should be connected to the electricity grid. So nothing to do with I guess regenerative electricity or anything on itself, and potentially no electric vehicles are included in this. The next big measure that's been announced is the payday super. So what this is that in effect at the moment, an employer has an obligation to pay your super quarterly up to 28 days after the end of the quarter. From 1st of July 2026, the government is going to mandate that all employers do pay their super from on the same day that the net pay is paid to the employee's bank account. Now, this is to make sure that the money that does belong to the employee is getting paid to the super fund, and it can compound and earn investment returns there, and to make sure that if a business is not going too well, the business doesn't fold, we're still owing employees money. This isn't really a surprising measure. Single touch payroll's been in for a while. We've seen a huge increase in audits on late and unpaid super. So this is this was the next logical step for the government to bring in. So what is happening in the meantime, and this is from July this year, the government has announced an additional $40 million to the ATO to improve their detection and audit systems. So for the time being, I would be making sure that you are paying that super on time every time, and potentially paying it in shorter periods. Whether or not you start early, if cash flow allows to pay every pay period, that's great, but if not, I'd at least be looking at it on a monthly basis for best practice. Once again, we are happy to discuss. The next sort of thing that was mentioned was an incentive for build-to-rent programs. So this is to try and ease the housing affordability crisis with rentals. And basically what they're looking at here is increasing the depreciation from 2.5% to 4% on the bones of a building that's bought. So when we say the bones, we mean the capital work. So the slab, the frames, the roof, that kind of stuff. So at 2.5%, you're saying that the building has an effective life of 40 years. At 4%, we're saying it's 25 years. So it's not really giving you any extra bonus, but what it is doing is really bringing forward those deductions, which make it a bit better up front. The government has also announced that they're reducing the withholding for foreign investors into this. So the government's really trying to get some foreign investment to help build these projects, and that's being reduced from $30,000 to 30% rather to 15%. And this is basically for projects that consist of more than 50 houses, so it's probably not something that any client specifically will do on their own, but it is something that could be done with JVs and getting some capital and all that put into place. Happy to discuss again. Back to the topic of super, and this is more to do with super funds and everything else in these areas. So everything with this, I think, has already been announced, but the $3 million super balance cap changes are coming in from July 2025. So this means that if you have an individual super balance, this isn't the whole fund, but each member's balance, if their balance is over $3 million at the end of that financial year, the earnings on the amount that attributable to the amount over the 3 mil get taxed at 30% rather than 15%. So it's not a tax on the entire balance, it's just a tax on the additional earnings. Worth mentioning as well, just on the super side of things, for people that are in the pension phase in their superannuation, the COVID relief of having reducing the pension drawdown by half for the last few years is expiring. So 2023, you can still access these concessions, but from 1 July 2024 and 1 July 2023 and the financial year about to start, the pension drawdown rates go back up to the normal limits that are applicable to that pension there. The only other change, once again, this was announced a few months ago, is the transfer balance cap has increased by 200,000 to 1.9 million. So for people that are about to enter into pension phase, they can transfer that amount from their accumulation style fund into the tax-free pension and enjoy tax-free earnings, I guess, over the years. Now, the next topic we're going to talk about is the ATO and their compliance. So the ATO is looking at employing another 2,372 staff in the next financial year. This, you could say, is a good thing. It'd be nice to get some good customer service, but what this means is more compliance and more audits. The government is spending this money to try and basically recoup some revenue. First thing that they've announced is that they're going to be really nice to small business holders and increase the amendment period from 2 to 4 years. Now, a lot of taxpayers already had a 4-year amendment period, but they've made it sound like, oh, this is great. If you make a mistake on your return, let us know. You can make that claim and get some more money back up to 4 years. But this is a double-edged sword. Basically what happens is the ATO has that long to audit you as well. Now, when the ATO is saying that they want more time to audit you and they're investing in compliance and tech, this means that they're going to use that tech to try and recoup that investment by auditing taxpayers. So it's a good opportunity to make sure that your affairs are in order, that you can, you've got some good defence for anything that is potentially to be looked at in an audit, and also consider audit insurance if it's there. On top of that, so 588 million is being invested in over the next 4 years for GST compliance. What they're looking at doing here is they're focusing on GST refunds and credits, and what they're wanting to really invest in is accurate reporting, analysis, and data matching with third parties. So this is going to a stage where it's not going to be just on the information that you've reported on your BAS anymore. They're going to look behind the scenes and see if they've got other information that they can sort of data match that to see if things are correct. Similar to what they do with property purchases and sales at the moment, but and also with ride share schemes and other bits and pieces like that, where there's that ongoing data matching. On top of that, there's $90 million that has been attributed to personal tax compliance. It's strange this year, it doesn't actually look that this is focused on what they usually say is work-related expenses and everything else. While the ATO has their existing compliance programs on that, and I think that they've been, I dare say from the ATO side, working pretty well, because there have been a headache from our side. This $90 million seems to be a focus on short stay rentals and making sure that, houses along the coast are genuinely available for rent. So, if you've got an Airbnb or anything like that, they're going to be pulling a lot of data in from, these short stay sort of providers, and making sure that these times that you are available for rent do correlate to your tax return. I dare say they'll do some Google searches and things like that for properties that may not be on the bigger platforms. The ATO is also going to start cracking down on small business tax debts that are greater than $100,000. Once again, a little bit weird in the way that the budget announcement was on this. It's not for all taxpayers that are owing over $100,000. It's going to be on tax debts that are over $100,000 that are more than 2 years old, but either belong to a multinational or by a person who controls over $5 million worth of wealth. Now, how the ATO determines that $5 million, that'll be a little bit rubbery, because we won't know how that's determined and what they've looked at in the background. But it's interesting to say that that's the main area that they're focusing on. I dare say that there will be focus on larger debts and everything in the smaller side of things. We have seen increases in ATO audit action and collection activity in the last few months. And from conversations we've had with liquidators and administrators, they've seen a huge uptick as well. Now, the other thing that has been brought in, this is a little bit of good news. So for people who have been late or maybe haven't lodged tax returns over the last few years, there's going to be an amnesty from the 1st of June 2023 up until the end of this year, so the end of 31st of December 2023. Any lodgements that you make to the ATO that were originally due from December 2019 to Feb 2022, they are going to waive any failure to lodge penalty. So this is a good opportunity to catch up if you are behind on some of these lodgement obligations and not be penalised. The ATO will likely still charge you general interest charge on any amounts that are outstanding, but at least there won't be that fine as well. Now, the items that weren't really talked about, so there was no discussion of the Lamido being extended. So what this means is that any taxpayer that last year had a taxable income of $45,000 to about $125,000, they are going to be $1,500 worse off this financial year. So either as a reduced refund or an increased tax payable. So the Lamido, or also called the Lamington, I think in some of the newspapers, was the offset that was given in the stage 1 and 2 tax cuts. This is now basically expired, and then this year there is that, I guess, higher taxing by not having that Lamido, and that's definitely going to affect a lot of people's refunds. And then from July 2024, the stage 3 tax cuts will come in, and that will sort of make up for that. So it was all planned the whole way along from when the Morrison government announced this back in 2017-18. It's just that the Lamido was extended for a few years, and then it was given a bit of an extra sugar hit last year during COVID to look good, probably as an election sweetener to win. Didn't do them too well. But this year, yeah, it's basically losing $1,500 if you're in that 45 to 120 bracket. And then on the topic of the stage 3 tax cuts, there was no news on that. So being that they are legislated, we do expect that they will come in from 1 July 2024, and that's what we'll be planning for. We'll see what sort of happens in the meantime. There was also no mention of the Division 7A reforms. So at the moment, when we're discussing Div 7A, you've got the choice of a 7-year loan unsecured or 25-year loan secured against a property. We've had a bit of chat with a lot of clients about these recently. The reforms are to scrap the 25 and 7-year loans and just have a 10-year standard loan. I believe it was unsecured as well. This has been talked about for many years and is due to come in from the year after it gets royal assent. Based on where we are at the moment, it's not likely to come in at least until 1st of July 2024, but the fact that there was no mention of it, it's probably going to be beyond that again. Loss carryback also is expiring again at the 30th of June this year. So this was the concession where if you made a loss in your business, rather than having to carry it forward into future years and get the tax benefit then, over COVID there was a concession that you could recoup some previously paid tax, so to assist with cash flow and those losses. So this will be the last year that this can be claimed, and it's something for all of our service clients that we're actively looking at with tax planning with you if it's relevant. The skills and technology boost is still before the Senate. So this is the skills boost was the bonus 20% deduction, similar to the energy thing that was announced earlier in this video and last night. The skills boost is due to go till 30 June 2024. We haven't heard anything. Morrison announced it. It wasn't sort of changed back in October when Labor came back in. It's still there. Who knows if it will happen, but the worrying one is the tech boost. So the tech boost is supposed to expire at 30th of June 2023 and it's still not law. So we've got no idea what's going to happen with that. The fact that it hasn't been extended, I feel like this might go silently into the night and just never be spoken of again. So I wouldn't be doing any special sort of tech bonus, tech investment or skills investment, hoping for those offsets. Apart from that, I think that's probably the main key points. Even though there's nothing overly exciting, you can see there are some movements in the personal the personal tax space as well as the small to medium-sized businesses. Hopefully this has been informative to you. We do have a guide that has a lot of these measures in more details, as well as expands onto some of the other measures that weren't sort of worthy of putting into a short video. The guide is going to be, if you're reading this from our newsletter, you'll see it there. If you do want a copy of the guide and you're not on our newsletter, feel free to head to optimisedaccounting.com.au and sign up and we'll send it to you straight away. Have a great day, and if there's anything else we can help you with, do not hesitate to